There's a constant economic battle being fought that most people don't understand. Now, it's not fought with missiles and tanks, but rather basis points and balance sheets. Now, every time new millionaires and billionaires emerge among those who have learned to read the signs. Why? Because they understand the money flow. These individuals start to see the current changes as our Federal Reserve and other central banks around the world transition from quantitative tightening to quantitative easing and vice versa. In 1971, when Nixon ended the dollar's convertibility to gold for foreign countries, it removed America's last remnant of a gold standard. This gave the Fed more power to print money at will with fewer constraints. But how does that money actually enter the system? Who touches it first? And where are you in that line? Understand these questions and you will survive the financial games that the Fed plays. But those who don't will continue to lose their savings, their purchasing power, and their assets to those who do. Let's go. The Federal Reserve expands or contracts base money, which is bank reserves, vault cash, plus physical currency held by the public, by buying or selling U.S. debt, like Treasury bills, Treasury notes, or Treasury bonds. A Treasury is simply a loan to the U.S. government for a set period of time. A Treasury bill is usually 1 year or less. A Treasury note is greater than 1 year up to 10 years. And a Treasury bond is usually greater than 10 years, typically 20 to 30 years. Now, the investor will be repaid their principal plus interest at the maturity date of the Treasury. Now, you will hear all of these terms, bills, notes, and bonds, lumped together under the U.S. bond market. Next, let's talk about the federal funds rate. The federal funds rate is the rate by which banks borrow and lend to each other overnight. Now, this rate is set by the Federal Reserve. The federal funds rate helps to set the benchmark for borrowing costs. It helps banks to establish their prime rate. The bank's prime rate is typically the rate at which they will create loans for their most credit-worthy customers. And that prime rate is usually set at about 3% above the federal funds rate. Now, the customer's actual rate can be higher or lower based on the bank's perceived borrowing risk for that particular customer. Now that we understand a little bit about U.S. Treasuries and the federal funds rate, let's put a few more pieces together to better understand this money flow. Anyone can buy U.S. Treasuries, but there are certain entities called primary dealers that are obligated to participate in U.S. Treasury auctions. These primary dealers are usually associated with a bank and they help facilitate the sales of U.S. Treasuries on the open market. Now, believe it or not, the Fed actually buys U.S. Treasuries also on the open market. By law, the Federal Reserve Act prohibits the Fed from buying U.S. Treasuries directly from the Treasury Department and states that the Federal Reserve can only buy and sell government securities like U.S. Treasuries on the open market. These sales of Treasuries to the Federal Reserve from primary dealers become the entry point for newly created reserves. The Fed then credits the bank associated with those primary dealers with these newly created digital reserves, which increases the bank's ability to make loans, and that begins the flow of new money through our financial system. I want to take the time to outline some key points that will hopefully make things a little more clear. The Federal Reserve is the bank for banks, and your bank and other banks have accounts at the Federal Reserve. These accounts are credited with what are called reserves. So let's define reserves. Reserves are not cash, but they are cash-like assets. They are digital, not physical. They are created at will by the Federal Reserve to pay for things. Reserves are the currency that banks use between each other to settle transfers at the Federal Reserve. Just think of it as you sending money from your account to a family member's account that use the same bank. Now, if a bank wants physical cash for its day-to-day operations, it can order that cash from the Federal Reserve, that cash is called Federal Reserve notes. Real confusing. Reserve, Federal Reserve notes. But reserves are digital, Federal Reserve notes are physical. The Fed will then deduct the digital reserves from that bank's account at the Federal Reserve, and the Fed will then send that bank the requested reserve notes, which is cash for those deducted reserves. Reserves and Federal Reserve notes are always swapped 1-to-1. So when a bank has too many Federal Reserve notes, aka cash on hand, they will send some of their Federal Reserve notes back to the Fed. The Fed will store those physical notes. The same way how you can go to the bank and deposit cash and then you see your account credited. Healthy capital and well-managed credit risk allow banks to make more loans. Now, Treasuries and cash are both HQLAs. High quality liquid assets. Banks don't lend reserves to me and you. Now, reserves are transferred between banks, but by holding more reserves and cash, it gives them more room within regulations to create new loans and deposits. So when a bank swaps $100 in treasuries for $100 in digital reserve, they've just primed the pump to create greater money expansion. When the Fed prints money, what they're doing is actively purchasing treasuries and crediting the banking system with new reserves, which are digits that they magically created with a keystroke. Now, because of how our fractional reserve banking system works, some people estimate that every dollar of cash that is deposited into a bank could potentially be securing $6 to $9 in the actual economy. When a bank makes a loan, that money is spent and deposited back into the system, often at another bank. That new deposit supports more lending. Round and round, this is repeated. The result is broad money can grow by multiples of the base money the Federal Reserve introduced as reserves. So the Fed introduces the money and banks broaden the money with their fractional reserve lending. An oversimplification of this is the Fed creates base money, cash, and bank reserves, while commercial banks multiply that money through deposits and fractional lending. So why does any of this even matters? It matters because when money is first created, that's when it's most valuable. But as time passes and that money makes its way through the economy and the market starts to reprice due to increased cash into the economy, supply and demand economics take over. More money in the economy means that all money is now a little less valuable. It matters also the rate at which you can utilize this new cash. That's why when the Federal Reserve cuts rates plus announce balance sheet expansion, businesses and savvy long-term investors strategically borrow newly created money to strengthen their portfolio by buying valuable hard assets and stocks because they know that current prices won't last long, that they only have a limited window to maximize their purchasing power. This is called the Cantillon effect, named after 17th century French-Irish economist Richard Cantillon. New money isn't neutral. Those closest to the spigot, governments, big institutions, well-capitalized borrowers access this money earliest and the cheapest. They buy assets before prices adjust. By the time wages or small businesses' credit rise, most markets have already been repriced. This is why people always say wages aren't keeping up with the cost of living. So what can you do? First of all, please don't go out and just start borrowing money. That is a recipe for disaster. But you should start to educate yourself and learn more about these boring things. Follow the Federal Reserve and their FOMC meetings. Understand the current rates and whether the Fed is cutting rates, raising rates, or keeping rates the same. Understanding whether we are in a quantitative tightening or quantitative easing state is a great first start. For example, at the last federal meeting, they announced they were cutting interest rates by another 0.25%. They also told us that they would officially end quantitative tightening on December 1st. Although not set in stone, these are the beginning signs that more money creation is about to begin. Now, these things could take months or even years to play out, so stay informed and position yourself accordingly. Policies don't just change prices, it changes who gets a head start. Map the path, know where you stand in line, and the next policy shift becomes a playbook, not a surprise. If this has helped, please like the video, subscribe, and follow for more. And tell me in the comments where you are in the money flow.